HDFC Bank, that's the stock that is taking the top honors today, up over 3% as the bank's latest shareholding pattern shows a 55% drop in FII ownership, suggesting headroom for further flows.
V-Mart, Moil and IEX, all of them surge after delivering good first quarter business updates. V-Mart sees quarter one total revenue rising by 16%, while Moil's quarter one sales rise by around 14.5%. IEX also sees a 25% rise in the total electricity volume in June.
M&M Financial dips on the back of its quarterly business update as asset quality deteriorates. Disbursements in the first quarter also come down 16.6% sequentially.
Power financing companies, PFC and REC, both of them zoom after brokerage firm Bernstein initiates coverage on both the stocks with buy calls, citing both stocks as their preferred plays in the power cycle. Bernstein tells CNBC-TV18 they expect earnings CAGR of around 12 to 13% for both these two companies.
KEC International zooms after the company bags orders worth nearly 1,000 crores in the T&D renewables business.
Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangla Malu. And at the top of the screen, as you can see, all the indices trading well in the green. HDFC Bank, that's the poster boy for today's trading session. But giving it company on the upside is a lot of those banking names. That explains why the Nifty Bank made a fresh all-time high and it's holding with a gain of nearly around 950 points. Hey, Mangla.
Absolutely, Nigel. You know, we thought that maybe the pop that we saw in the Nifty Bank may get sold into, given the sort of rally that we've seen on HDFC Bank in particular. Yesterday as well, that stock ended at the high point of trade, even as the Nifty Bank was slightly weak. And today, what's powering the Nifty Bank is the call writing at 53,000. You know, once we cross past that mark, a lot of those call writers at 53,000 who were hoping for the Nifty Bank weekly options expiry to be below that level are now running for cover, causing further up move on that index. But the baton has been passed. You know, over the last couple of trading sessions, we saw, the IT stocks do extremely well. But today, the IT index is actually taking a bit of a backseat. No problems for the market as the Nifty Bank says that I will do the honors today. So the IT index at the low point, the Nifty Bank at the high point with a gain of 150 points on the Nifty. Let's talk about the primary market then. Emcure Pharma's near 2,000 crore IPO has opened today for subscription. Will close on the 5th of July. So to discuss the objectives of this issue and the post-listing growth strategy, we're now joined by the MD and CEO of the company, Emcure Pharmaceuticals, Satish Mehta, along with the whole-time director, Samit Mehta. Thanks a lot, Satish and Samit, for joining in. Congratulations for coming to D Street. It's a near 1150 crore offer for sale, 800 crore rupees, or rather 600 crore rupees in terms of fresh issue. 800 crore is the fresh issue, of which 600 crore rupees is what you've allotted for debt repayment. So the first obvious question then is, what's the total debt on your books as of right now? With the debt repayment, what would be the delta when it comes to your finance costs? How much will they come down by?
First of all, good morning, and I very much welcome the opportunities of interacting with you. Thanks a lot. Obviously, this is a great moment in the history of the company, in the sense, somebody like me who started his career in early 80s and started with a handful of people. In fact, I'm a graduate from IIM Ahmedabad, only person, from my batch who did not, for any placement because I felt, I will do something on my own. And this has been a journey of last 40 years, in the sense, I very jokingly keep on saying that in my 40 years journey, I never got any promotion because I started as managing director. I continue to be a managing director, CEO, even today as well. So this is what it is now. Coming back to what you asked me, the question, very specific question. As far as the debt is concerned, as reflected in RHP on 31st of March, it was something, close to 1,550. And out of that, 600 CR, out of 800 CR that we are raising on account of primary, will go for reducing the debt.
All right. We will ask you about the reduction in finance costs and the impact on the EPS thereafter. But you jokingly said that you've never got any promotion in your life because you started out as MD. Well, if one got, the position of MD and the 1% commission of profits as salary that are amounting to nearly 22 crore, I don't think anyone would mind. So that's just on a lighter note, Nigel.
Well, that's right. And, Mr. Mehta, you went straight into bat at the opening, whether it was Sachin, Virat, Rohit, all of them, they started in the middle over, and then in fact middle order, and then they went into the top of the order. But you debuted straight at the top, so good on you. But let's get back to the numbers then. As you said, out of the total money that you're raising, 600 crores will be used for debt repayment. So what does it bring your debt number down to? Point number one. And point number two, the 600 crores, what was the borrowing cost of it? So we could get an annual saving on that number?
No, that's a good question. But again, coming back, to this one, that as far as Rohit and all these guys are concerned, they become international players. As far as I'm concerned, I started in league, small league, in Maharashtra. So to that extent, there is no comparison really. It's a great feeling, to lead this great company that has been built, with a lot of passion.
Yeah.
And coming back to what you said, that as far as 600 CR is concerned, that is going to be for reduction of debt. So obviously the interest cost, should go down, and obviously that should get reflected in EPS as well. Now listen, as far as I'm concerned, the numbers, they're all in. I think the cost of interest is around 8 or 9%, so that should obviously get reflected in the PAT, going up going forward.
So 54 crores ordered will be the savings.
I imagine so.
Yeah, okay, all right. And the debt number comes down by how much once you repay the 600 crores?
As I told you some time back, as the debt is concerned, that was 1,500 ballpark figure.
Okay.
On 31st comes down, and again, what really happens going forward, the company should also generate cash. So I think, we are quite comfortable. And having said that, I must tell you that built up the company from scratch. So to that extent was not really averse, to borrowing.
Got it.
And that's what is getting reflected because, as I am listing the company today, the promoter group, holds 83% of the equity. So I think, in my career, long tenure of 40 years, there is not a single incidence where we have missed the financial covenants.
Got it.
So I think,
Sure.
it's a new journey and we are very excited about it.
All right, you are excited about it. Let's bring in Samit in the conversation as well. Samit, I'm looking at the last 3 years, the data that you guys have provided. The revenue has grown at a CAGR of 6.6%, which is actually, one would say, a lot lower than what a lot of the other companies in your peer set have grown as well. And in doing so, your EBITDA has actually declined at a compounding of, or rather discounting of 4%. And the EPS also has declined on an annual basis by a rate of around 13.5%. So going forward, I just want a couple of details. One, what is a sustainable rate when it comes to your revenue growth going forward? What is a sustainable margin that you're looking at? And as a result of which, what could the growth in your company's EPS be? Because the last 3 years, we've seen a decline.
Absolutely. I think a couple of things that can explain, the numbers that you were just mentioning. Of course, if you start off with FY22, there was a bit of COVID noise that, the entire industry experienced. We were also beneficiaries in terms of a lot of our products like zinc, vitamin C, enoxaparin, gaining high revenues in that specific year. Other than that, I think the growth has been, quite steady. Specifically talking about the EBITDA and the PAT and, subsequently the EPS, two things that have happened also over the last 24 months. One is we have consciously invested in increasing our field force. So we have, enrolled more than 1,000 medical representatives over the last 18 to 24 months, which is almost a 25% jump compared to where the number was earlier. And the second is there's been a significant capex over the last 18 months in the second wave of investment, given that, most of the first wave facilities were reaching optimal capacity utilization. Giving you some outlook, I think, I can talk about the three functions and give you a perspective there in terms of R&D, manufacturing, and BD. And, the kind of initiatives in terms of R&D and manufacturing, creating the additional capacity, we see a lot of runway. We've made the right investments in science, technology, and innovation, which should continue to drive growth. And of course, Sanofi partnership is one example of the in-licensing. We will continue to work on several more partnerships.
Okay, all right. Just want to confirm R&D as a percentage of sales was, I think, around 4.5 to 4.7%, right? Will it hold around these levels?
That is correct. We believe, as has been historically, anywhere between 4.5 to 5% is our investment in the R&D.
All right. And, you won't be able to give us the fixed number, but on listing, we'll try to squeeze that number out of you all. But margin trajectory will improve from here on?
So a couple of things, right? Once the debt reduction happens, and like you correctly mentioned, the interest cost or the financial cost improves, that probably should flow in, right, in terms of an improvement that could happen in terms of either the PAT or then subsequently the EPS.
Okay, all right. The pattern EPS, but we'll want further color on the operational performance because obviously that interest cost repayment will come post the operational performance. Be that as it may, let's understand the business a little bit more in detail. The domestic as well as the export mix, currently it's at around, I think, 49-51% odd. How do you see this number progress moving ahead? And also you're forayed into the CDMO business, right? What is it as a percentage of your total mix and where do you see that number headed to?
Sure.
Question. Before going for this question, I would just like to add to what Samit was saying some time back, that as far as the 1,000 medical representatives that we have added, it takes time, to reach the productivity, desired productivity. So as we increase the productivity, that should also have a positive impact, on the EBITDA and margins that we have. And the second thing, that we had 9 manufacturing facilities, we added 4 manufacturing facilities. So that will also take some time, to ramp up. So that is something, we'll keep on doing. The other area that I would like to say, draw your attention, the way the company has been built up by us, we have essentially been focusing on science, technology, and innovation. That has been the gene of the company. So to that extent, I think, the type of differentiated products, that my company has given in last, 25 years of our journey in marketing, that will continue. That is something, which is very close to our heart, whether it is chemistry-driven products or biotechnology, that we'll keep on doing. That's the core of the business. Now, coming back to what you asked, about exports. As far as exports are concerned, I mean, we all like, the emerging markets. I mean, the way we are extremely passionate about the domestic market, and we want to grow in the domestic market. That's the main area we will pursue. But at the same time, we like emerging markets, because they mimic the domestic market, to a very great extent. There are a lot of countries, where we sell branded generics. And there what really happens, the products, that we have in India, which are differentiated, or the biotech products, that we have, they also have a very good future, in the emerging markets. So we are very bullish about emerging markets. And as far as Canada and Europe is concerned, we have done well. It's on the back of the acquisitions, that we had in 2014-15 and the recent acquisition that we have in Canada. So that will also be driven by complex products and complex injectables, to give some color to the whole thing. I would also like to add. One more thing. Emcure is the first company which has got approval for amphotericin B, a liposomal injectable, very difficult, complex, to manufacture apart from the innovator Gilead in UK.
So we get that, Mr. Mehta. We get that. What we really want to know before we let you go quickly is where do you see this mix going? Export versus domestic, and also acute versus chronic. Where are the margins better?
Yeah, coming back to, what you were saying, absolutely spot on. As far as today is concerned, 48% is being given by domestic contributor, 52% comes through from export. I would like the ratio by and large, will remain same, but I wish, as far as the domestic is concerned, it tilts, towards domestic. I'll be happy if domestic is 53, 54, 55, and as far as the exports are concerned, that is, 45, 50 or whatever it is. So focus will be on the domestic market. That is something, which will happen. And the second question that you asked me was regarding, acute and chronic. So today what really happens, that acute and chronic, we do around 45% in chronic and 55% in acute. But at the same time, what really happens, we are very strong in gynec. In fact, gynec is one area where we are leaders by distance. So as far as gynec is concerned, some time back, that was taken as subchronic. If you add that, in that chronic and subchronic put together, we are at 70, and 30%, is coming purely from acute, where you are talking about anti-infectives and pain management, gastrointestinal products, and so forth and so on. So basically, as far as chronic is concerned, the area we like. And obviously, as far as chronic is concerned, the margins are better, and company will keep on, focusing on that. I would also like to draw your attention to the recent, arrangement that we have entered with Sanofi, where we got their portfolio of cardiology And even for that matter, 220 medical representatives of Sanofi,
Right.
they also joined the seamless, what I would say, induction of these guys, took place in MQ.
Right.
That will also help us to build
Got it.
on the chronic portfolio.
All right, Mr. Satish Mehta and Samit Mehta, thank you so much for joining us and giving us a brief look into what the company is all about. The IPO opens today. Of course, we will be joined by you when the company lists as well. And that time, we'll press you more when it comes to numbers and future growth prospects that you have, along with some specific questions that we'd have as well.
Yeah, Mr. Mehta, we have explained the company in detail. Post-listing, we are looking forward to those numbers. And where do you see the company headed in the next few years? For the time being, we appreciate it, both of you gentlemen joining in and filling us in on all of those details. Well, for the time being, we'll continue the show. We'll have to slip into a short break. On the other side, we'll get a technical check. Sony's waiting for us on the other side.
Welcome back. There's a big move underway in a couple of these names. Pull up Rallis India. The stock is up around 8%. A big move is what we've seen. The stock is at the high point. Giving it company on the way up is RCF and AMI Organics. Both of them doing extremely well in today's trading session. And also a lot of these financials are doing very well too. We have Hudco, which is up 6.5% as we speak as well. So there are big gains beyond the frontline indices as well, and beyond the HDFCs of the world. We're seeing a big move in some of these cash stocks as well. So good time to get in Sony Patnaik for a quick check on the way the market's moving from here on and the stocks that she would bet on. Sony, one was expecting some sort of resistance around that 24,250 odd mark, but now that we've broken out of that range, where do we go from here? Do you think this is a fresh breakout?
Good morning, Mangalam and Nigel. Thank you for having me on the show. Certainly, I think because Nifty is holding on to a very good support of 24,000, and you can also see there's a lot of put writing that has been happening since yesterday. So I think that level, as long as it's getting defended and intact as a good support, Nifty can head towards 24,400 odd levels. I think that would mostly be led by Bank Nifty's strength, which is clearly a better performing index. Even as per the rollovers, Bank Nifty has seen a lot of shorts getting squeezed out of the system. So Bank Nifty is essentially just left with a lot of net longs. So from current levels that Bank Nifty has broken above 53,200 today, it has tested those levels. There is a high probability of the index testing 54,000 for July series. So I think as long as the support for Bank Nifty also remains intact, Nifty may consolidate, but it can also test the higher levels. Stock specific, we can see a lot of heavyweights contributing to Bank Nifty. There's ICICI Bank, there's Axis Bank, which is looking quite strong, even Federal Bank. So I think these bank individually will also contribute to overall indices.
Got it. All right. What about, we've got that, Sony, on those banking names as well as on the index at large. Any more individual stocks you're tracking, if you'd give us levels on them?
Definitely. Nigel, the first would be from realty space, which is DLF. One can trade and longs at current level in futures. DLF futures can be bought at current levels with a stop loss of 820 and a target of 860, 865 can be seen. The second pick would be from the banking space, Axis Bank, which is looking quite strong at current levels. So one can take a position in Axis Bank futures at current level for a target of 1320, 1330, keeping a stop loss of 1245.
All right. Thanks a lot, Sony, for joining in and giving us your view on the indices. You like Nifty Bank more than the Nifty, and a couple of stocks that you've recommended to our viewers as well. Take a short break. Actually, before we do that, let's get you a few more ideas for profit coming in from colleagues at Money Control Pro. And today we have Madhu Chanda Day with an idea.
We're talking about FedBank Financial Services, or FedFina, which had a tepid listing in November 2023, and the stock has since then underperformed. Loan growth, however, has been robust in the past, and in FY24 it clocked a loan book growth of 34%. The loan book is predominantly secured, comprising of mortgages and gold loans, and the company is now gradually pivoting the book in favor of high-yielding assets like small-ticket mortgages and gold loan. It has also started co-lending in the gold financing business. FedFina has a strong parentage in Federal Bank and has seen a credit rating upgrade, which should incrementally lower its cost of funding. We therefore expect stable margin. With a largely secured asset book, asset quality hiccups have been rare. With a strong expected growth in loan book, stable margin, moderation in credit cost, and lower expected operating expenses due to operating leverage benefit, we see headroom for ROA uptake. The valuation is now reasonable in the context of a healthy ROA.
Thanks a lot for that, Madhu. For the time being, though, we'll slip into a short break, come back, continue to focus on markets and on stocks that are moving around. Don't go anywhere. Welcome back. You're tuned in to Chartbusters here on CNBC-TV18. Well, a couple of business updates came, namely on Avenue Supermarts as well as V-Mart. Manglam, tell us, those numbers were quite good, huh?
Those numbers were quite good, more for V-Mart than D-Mart, but D-Mart also has seen a bit of a rally from the lows, so which is why it's not moving as much. No problems with the numbers, though. Standalone revenue growth this time around for the first quarter for D-Mart, 18% higher, close to around 13,712 crores on the top line, and that is in line with the last 3 year CAGR of around 18.2% as well. They've added 6 stores during the quarter. Total stores stand at around 371. And if you look at last year and this year, the store addition is close to around 13.5%. So revenue growth of 18.5%, store addition of 13.5% implies that there could be around 5 to 6% same-store sales growth positivity. So to that extent, it will be very important to see what has sold. So you look at the product mix, you look at the gross margin trend, because that has been an imponderable for D-Mart. And secondly, these are standalone updates. So the performance of the e-commerce business would come by in the consolidated business. So those are some things that we'll keep an eye out on as well. Remember, the company had told us that in the very near future, their goal is to add as many stores in the physical retail and also look for moats in e-commerce business and grow that as well. The other one, which is actually a bigger mover in today's trading session, is V-Mart Retail, and that's because all of last year it was very slow, sluggish, poor performance coming in, and on that base the company is now showing growth as well. Total revenue grew 16% for the key business V-Mart. Their revenues actually grew 17%, and even if you look at the same store sales growth, this time around for V-Mart it has been around 12%. Unlimited, which is the acquisition that they made from Arvind, there the same store sales growth has been around 8% as well. They've opened 7 stores during the quarter, closed 3. They've added 5 V-Mart stores and 2 Unlimited stores, and they've also closed 3 Unlimited stores, and this is a positive largely because there is a big margin differential between Unlimited and V-Mart. So V-Mart has higher margins than Unlimited, so adding more V-Mart stores and closing some of the non-performing Unlimited stores are better for their margins. So as a result of which, we are seeing an up move on V-Mart as well.
All right, Manglam, thanks for that. For the time being, though, we'll have to wrap up on this edition of Chartbusters. You stay with us, though. Trading comes up next.